Okay, let's explore this equity accounting problem. Now, I want to first focus on the question. The question appears here. It says, what is the equity and Howell income that should be reported by Acker in 2012? Okay, so we're just going to focus on 2012 information. Here's what it tells us. Acker bought 40% of Howell on January 1st, 2012 for $576,000. The equity method of accounting was used. The book value and fair value of the net assets on that date were $1,440,000, and Acker began supplying inventory to Howell as follows. So in 2012, they transferred inventory with a cost to the parent company Acker of $55,000 to the subsidiary for $75,000. But of that amount, $15,000 was on hand at the end of 2012. They also tell us that Howell reported net income of $100,000 in 2012, and they paid $40,000 in dividends each year. Now, focusing on the question, what's the equity in Howell income that should be reported by the parent company in 2012? Here's the calculations we need to work through. First, they tell us the fair value of the assets is $1,440,000. We acquired 40%. So if we multiply those two together, we come up with the fair value of the amount we purchased at $576,000. Now the price we paid was also $576,000, so we have no excess of price paid over fair value. That means we don't need to worry about any stepped up amortization on assets that have a value that's different than the price paid, and we don't need to worry about goodwill. Okay, now next, we want to determine what was the 2012 gross profit on the intercompany sale. So if we subtract the $75,000 transfer price from the cost, the $55,000 cost, we know that there was a $20,000 gross profit recorded by Acker on its books, right? Now, if all of it was sold during the year, and this is how I think about it, then what that means is we're going to have to, and what I mean by all of it was sold, if all of it was sold by the subsidiary, in other words, we transferred it to the subsidiary, and if they sold all of it to third parties, we would have to reduce that stepped up value, because keep in mind that when a parent sells to the sub, that markup is really just a transfer. And we're using the equity method, we're going to record the income of the sub based on the percentage we own. So using that logic, if all of it was sold, we would have to eliminate 40% of the $20,000 if all of it was sold. But it wasn't. We need to add back that portion that was realized when it was sold to outside parties. Actually, let me say this another way. 40% of it must be eliminated. We could say if none of it was sold. Well, I'm probably making this more confusing than it needs to be, so let me just keep going. If we add back that portion that was realized when it was sold to outside parties, we'd realize that we need to take 1 minus the percentage of the $15,000 of inventory divided by the transfer price of $75,000. Okay, now in the calculation you see in cell C29, I've left off the thousands. I only need the ratio of 15 to 75. So 1 minus the 1575 tells me what percentage was really realized. So if we start off saying, hey, all of that's an intercompany sale eliminated, and then add back that portion that's realized, we would take 1 minus the remaining portion on hand. And when we subtract the $6,400, the portion that was realized, from the amount that must be eliminated, we come up with the deferred profits on inventory in 2012. Now, this approach may be confusing to you. You may find it easier just to calculate the percentage that's on hand in a different manner, but to me this is the logic that makes sense to me. So then, to come up with equity income, what you do is you take the $100,000 of income that was reported in 2012, right? And you're going to multiply it times 40% because you're going to record your percentage ownership of the subsidiary, but then you've got to subtract out the deferred profits that are still sitting in the subsidiary's income at the end of the year. Okay? And that's how you work through this problem. Or this is one way you could work through the problem. Thanks, everyone.